Good afternoon, ladies and gentlemen, and welcome to the Duke Royalty Limited Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Neil Johnson. Good afternoon, sir.
Good afternoon, and thank you everyone for attending this podcast or webinar, I guess, for the interim results for Duke Royalty. I'm Neil Johnson, the Chief Executive Officer, joined by Hugo Evans, the Financial Director. So,
afternoon, everyone.
Let's get started, and thanks again. So I will start with just an overview of what we do and what Duke Royalty does. In a nutshell, we provide a hybrid capital to private companies. These are usually owner-operated. They have long-standing, profitable businesses, and what corporate royalties are. We'll get into corporate royalties in a second, but it's really a hybrid between private credit, like debt, and private equity. And we'll show you what that means for investors. I want to talk about the three pillars of what Duke Royalty provides for investors and what we think about when we're doing a transaction. Number one, capital preservation. We have a long-term investment horizon. These are senior secured loans. We have alignment with the business owners, but the business owners keep equity control of their business. They're not selling their business to us. It's their business. But we structure our long-term participating loans as sitting above equity in the capital stack. The second bucket is what we provide to investors, an attractive dividend yield. So we have quarterly dividend payments, and what we've done since inception in 2017 is give investors quarterly dividends. What we try to do is a combination of the free cash flow per share going up that allows us to increase our dividends, as well as we want the reducing payout ratio, which is the ratio of our dividends to our free cash flow generation of our business. Our current annualized dividend is 2.8p, which gives around an 8% dividend yield right now. The third bucket is this kind of hybrid between private equity and private credit. And if you've been a shareholder for a long time and heard our presentations, this is something that unless we had a mature portfolio, we didn't really talk about. And this is how we structure, and we've been doing this since day one. But the buyouts, when the business owner wants to refinance us out or sell his company or her company, there is in every one of our transactions a built-in buyout premium in every case. And again, more and more, we're talking about minority equity positions that really are a sweetener for investors that we do. So those buyouts will typically increase Duke's internal rate of return from each investment when they get bought out. It is part of the model. We've always talked about it, but now actually there are some pretty significant potential buyout premiums and NAV increases with embedded within our portfolio. So that's the third bucket that we'll talk about today. And then other things that I want you to know, and we'll talk about the portfolio, diverse. We have actually 56 operating entities underlying our 14 royalty partners, because we do a lot of buy and builds and conglomerates. and that's the focus on an acquisition capital, as it says. We're really proud, and I'm going to hand over to Hugo when we do the numbers. Is just our record revenue, our strong fundamentals. We're focused on free cash flow per share, and we're not reinventing the wheel. Royalty investing has been around mostly in North America because we're the European leader, and you can tell where I'm from my accent. I don't have the accent, you have the accent, but we won't go there. But that's the royalty investing that has been around for decades. And then this is also something that 2023 has come to the forefront, but has been embedded in the way we invest since day one. And really it's revenue linked. So this makes our product inflation hedged. And as inflation increases the revenue of our underlying royalty partners, that adjusts Duke's distributions or our revenue up to a maximum of 6% each year. And Hugo will go on to that. That has been a tenet of how we've invested since day one. It's just inflation is now here, and we're excited to show how that protects our investors, from that depreciation of inflation. So without going too far into what exactly we do, because probably some of you have heard this before, we think of corporate royalty as distinct from other types of royalties like mining royalties, and now there's music royalties. And what is really important that we try and invest is in corporate and long-standing profitable private businesses. So they have a history of growth, and embedded in every one of our investments, we want growth over the long term. And if we do our job right, that's the revenue linked and the royalty that we can continue to grow. Oil and gas and mining, you're going to run out of gold or oil down in an oil well eventually. They're depreciating assets. And you can say the same thing about music, song play. They degrade over time. If we do our job right, that's really one distinction of what we do as corporate royalties, although the umbrella is really revenue linked. And so we have an alternative finance for SME businesses, basically. But why do the company owners want to deal with us? Well, they get to keep control of their business without refinancing risk. And that's important. What we do is we stretch the amortization of this loan over 30 years, but it's not a straight loan because of that hybrid between just a loan and being an equity investor. We can adjust once per year. We do adjust once per year of the cash flow that we receive based on the revenue, the audited revenue number from the company last year versus the year before. And then every year we look back and see how the business did. Now, that does, like in 2020, mean that we take pain. We take risk, that revenue falls and revenue goes up. And you'll see that in our portfolio, that of what kind of companies attract us. I will tell you that they're traditional companies, they're old economy businesses. Some can say them boring, but boring is the new exciting to Duke Royalty. So that's that, because there's fluctuations over market cycles. Most of our portfolio has been 30-year or more companies that have been in business for 30 years or more. A couple other things that I want to talk about, what corporate royalties give for both investors and business owners, is that our obligation can always be serviced out of the current cash flow of the business. So we don't need an exit event, and the company can always pay our distributions. and our revenue. So there's a lot of risk that taken out of that business of trying to get our capital back. Now, the company, no company that I've seen has a 30-year business plan that knows exactly what they're going to be doing in 2050. So what attracts them is that they're in control of any refinancing event. They may have a 5-year business plan. They may want to get from A to B. They may say this is the best partner for us to get to the next stage of our business. We're fine with that because they can buy us out. And circa 3 years is our minimum non-call period. But that's the genius of this model is when we have the when they have this refinancing event, they know exactly what they're going to pay us. It's a buyout premium, as I talked about in the previous slide. There's a bump in the return for Duke and our shareholders, and everything's in control of the company. So there is not a poison pill. Buybacks can be granted, even in that non-call period. So we're a very long-term and silent investor. However, you can imagine with senior securities, we have events of default, we have covenants. We ensure that the companies have adhered to that and keep paying us our monthly payments. Okay, and then lastly, before Hugo gets into the numbers, is really what we've built since we listed in 2017. So we just passed our 5th year of building, what we have become as the European leader in corporate royalties. I can kind of say we were in 2 phases, and basically pre-COVID, which was really us establishing our presence, focusing on cash. We paid a dividend day one, but we had to build the portfolio. We had to build the equity base, and we had to build the OPEX, which operating leverage is part of this model. But Hugo will tell you what we've been done since the second phase, which is really COVID and last year, which really demonstrated for our investors, our downside protection. We talk about senior secured, but what happened in COVID? Well, we grew our cash flow, is what happened in COVID. So it also demonstrated the life cycle of investments because we had some buyouts, and we really defined the market segment, and we solidified our lead and our the way we invest, both for investors and for business owners, because they understood what it meant to have a partner for the long term and not ask for their money back when you break a covenant, day one of COVID, and be into a mess. And we can get into recessions and everything like that in the future. I'm sure there'll be a question or two. Right now, what we're focusing on is solidifying our first mover advantage. We have the market segment, we have the market to ourselves. But for investors, it's all about that operational leverage now, increasing the free cash flow per share, which is a great segue back onto Hugo. And I'll turn it over to you, Hugo. Thank you.
Yeah, thank you, Neil. And afternoon, everyone. So obviously, I'm going to talk to you about Duke's financials over the last 6 months, and obviously, it gives me a lot of delight really to talk about these results. You'll see significant increases in really our core metrics across the board in the last 6 months. For those of you that don't know us that well, cash flow generation is fundamental to this business. We are a quarterly dividend payer. I measure the majority of my core metrics on cash flow rather than the income statement, and I can talk a little bit about that later, but mainly to avoid all the fair value accounting movements that the auditors like to put in. I'll start with obviously top line cash revenue increased interim period on interim period up to 10.4 million from 7.8. Free cash flow increased sort of 50-60% from 4.6 million to 6.6 million. Both really driven by the increase in deployments that we saw in the latter half of throughout FY22, to be honest. Historically, the business has always put out about 25 million of new deployments a year. Last year, we did 75 million alone. So, a significant increase in deployments would obviously lead to an increase in that top line cash revenue. But also, it's not just the sort of the top line. I'm very proud of the fact that while all our top line metrics are increasing, it's really the per share metrics which ultimately are even more important. And you can see that total cash revenue per share has increased by sort of 20% up to 2.7p. Free cash flow per share has increased again from 1.4 to 1.7, continuing the increase from the prior period. And again, even while I wouldn't normally sort of focus on the income statement, I think it is always important to show the metrics across the board. So net income has obviously gone up to 10.3 million, but adjusted earnings per share. Now this is an important metric because it does remove the fair value movements across the portfolio, so it gives you a sort of truer flavour of the operating performance of the business. So as you can see, metrics across the board, top line and per share, all increasing. Again, driven by that increased deployment, and I would expect that to continue into the next 2 or 3 quarters as the business grows. Focusing really just on that top line cash revenue, as I said, you can see that quarter on quarter since Q1 FY21, which was actually the start of COVID. It was sort of the April to June quarter when we hit lockdown. Naturally, you would expect a drop off in our revenue at that point when a lot of companies, we all experienced lockdown. A lot of companies' revenue fell off very sharply, and as you may remember, we allowed or we gave forbearance to a number of our companies to alleviate some short-term liquidity. But ever since then, you can see every single quarter top line cash revenue going up as we deploy more capital. But what I'm really proud of is the fact that we have a largely fixed operating cost base. So what that means is that we are, as we grow our revenues, and we're able to keep the cost base largely fixed, it means our operating leverage improves. So back in taking out those 2 quarters of COVID, you can see Q3 FY21, Q4 FY21, we were running at about a 20% operating leverage, i.e. Operating costs were 20% of total cash revenue. That's now down to circa 10% in the 2 quarters of FY23 in this interim period. So, really important. Why does that help? Well, ultimately, as a dividend paying business, we want to do 2 things. We want to increase our dividend steadily over time to pay more to our shareholders, but we also want to be able to, over time, try and reduce that payout ratio, i.e. pay less dividends as a percentage of our free cash flow, because that will allow us to reinvest more of our free cash flow back into the portfolio, and I'll comment on that in a minute. But ultimately, very, very pleased with the slide showing that operating leverage, and hopefully we can continue that again through the rest of the year. So just really sort of talking about the free cash flow, as I said, starting with the portfolio cost, obviously, top line cash revenue and free cash flow is all driven by us being able to deploy more capital. FY22 was a fantastic year. As I said, we deployed 75 million of capital. FY23 has not been as strong, but really that's more from we took a view, given the macro environment, that to pull back speed of deployments. Businesses are everywhere have found 6 months, and indeed I'm sure will continue to do so for the next 6 to 12 months as we enter into recession. So we are being very careful about how we deploy our capital, We raised 20 million of capital back in end of May. And as I said, we deployed, in the interim period, 6.5 million. We obviously did another, you may well have seen another new deployment into a company called New Path Foreign Security in November, which was million, but we've only deployed 11.5 million year to date. As I said, against the 75 million that we deployed last year. But, that's a sort of intended consequence of what's going on at the moment in the world. But as you can see, the increasing portfolio cost leads to increased total cash revenue. As I said, because of that largely fixed cost base, it allows us to grow that free cash flow per share. And you can see that very clearly increasing from interim 21, 22 to 23, and then and our dividend per share going back up. And as I said, that is our aim, is to be able to steadily increase that quarterly dividend while reducing the payout ratio. You can see, as Neil said, we're currently sitting at a 2.8p annualized dividend, and we've paid over 30. Well, we've paid exactly 13.7p of dividends since inception. Just touching on the balance sheet as well, I obviously focused on cash flow for a reason, and we've touched on the income statement. But the balance sheet, I don't generally tend to sort of focus too much on NAV, mainly because we are, a dividend-paying business, and over the last sort of 4 or 5 years, we've paid out a significant portion of that of cash flow out as dividends, and therefore you wouldn't naturally expect to see significant increase in our NAV per share. However, you can see the balance sheet clearly getting a lot stronger. Royalty investments have increased over 2 years from 80 million to 171 million. A lot of that obviously driven by the fact that we are raising capital in the equity markets and drawing down on our debt facility, which allows us to invest a lot more into our royalty investment book. That actually is also, you'll see, is slightly driven by increases in fair value over the last 12 months. As there were significant write-downs following the COVID sort of period. We saw bounce back in those fair values the year after, and again, the last 12 months have seen all our underlying businesses sort of strengthen, and as a result, the fair values are now sitting just above cost, only about 2%. And the great thing about our business is that you will never see, while there are mark-to-market movements, you will never see, outside of a sort of black swan event like COVID, you shouldn't normally see significant swings in that fair value. You also won't ever really see the fair value going significantly above cost. We have redemption buyback premiums attached to all of our investments, and therefore the fair value will never go above cost plus buyback premium, which generally ranges from sort of 20 to 25%. You'll also see actually the significant movement on the balance sheet is from just under 5 million to over 11 million. In equity investments, as Neil sort of talked about, we've become a sort of a hybrid between private credit and private equity, and we have started to place more emphasis on trying to obtain small minority equity stakes wherever possible. We currently have 10 equity stakes in the portfolio, and as our businesses start to mature and strengthen, you will naturally obviously see those equity investments start to increase in their fair value. We use a very sort of standard way of valuing those. You take a forward-looking EBITDA forecast number and apply it to a sort of a market multiple, which significantly discounted on the back of the fact that we're investing into SMEs. But really just you can see the net assets have increased, but our net asset value per share is increasing year on year as the strength of the investment portfolio increases. So just sort of summarize overall, it's been a very strong 6 months for us. We've got record cash flows, quarter on quarter cash flows. The operating leverage is kicking in as we try and manage and keep that cost base largely fixed as much as possible. That's leading to increased sort of cash flow generation, going down to sort of filtering down to our free cash flow, which in turn can obviously help to increase that dividend going forwards, while at the same time seeing our balance sheet strengthen. Neil, I'll pass it back to you for some of the portfolio highlights.
Great, thank you, Hugo. and want to save some time for questions. It's 11:25, so we have we're 4:25, so we'll. I want to go through the portfolio. I'm going to keep my eye on the questions as well. But as a summary for our portfolio, I think the portfolio is in great shape. It's never been better. We look at not only the portfolio book cost, which increases as we deploy, but the single name exposure, which is obviously diversification of our revenue streams, will reduce the risk on any one royalty partner. So we have declining there. We also, as you can see, one of the metrics that can be tied to the health of the portfolio is the contractual payments made, and of course the year end of 2021 is our fiscal year, which was April 1st, 2020. So that was the COVID year, but it runs above 90% in normal years, and we haven't seen that degrade in 2020, fiscal 23, and the portfolio net leverage. So this is our amount of long-term debt over the EBITDA of the company. So that is also at lows, and the debt service coverage. So this is the cash flow that services our payments. And we like to take a minority of the cash flow, and that means that in a portfolio that if it's over 2, if that number is over 2, then there's more than twice the amount of EBITDA for our payments. So that means we're taking less than half. Sorry. So we've seen that post COVID, and the average portfolio cash yield. So this is going back to the inflation hedge point, and how much of our initial portfolio book cost that is in cash yield. And so with positive resets that we have had this year, is at all-time highs. And I think one of the questions that I can talk about right now is really, what are we doing in this higher interest rate environment to have, what was the question? It was something around, how have we changed what we do in our interest rates have risen, how that impacted the IRR hurdle for our new loans. Yes, and we have always done the same thing. I mean, I think that's a recurring theme. We took a model that has worked for 40 years. It worked in the 80s. It worked in the high inflation, high interest rates in the 80s, worked through 2008, and the boom years and the bust years. And so we don't have to change what we do. What we have we talk about us being a flexible solution. And so there are different levers that we can pull and push to get our stated IRR goals, which are in the high teens on a normalized basis. And one of those, of course, is the entry. It's not a coupon; it's all encompassing distribution, but the coupon of the loan. So we've always said, the distribution is between 12 and 13.5, 14. We have done, as we're going to talk about our latest new royalty partner, we're at the high end of that range, and we have lowered that back in other years, because we've pulled another lever on the back end to when we get bought out, there'll be higher buyout premiums, for example. And we're hoping that, just like we have experienced this year, that a 13% this year becomes a 13.8% next year, because it's a positive 6% adjustment off of that 13%. So all our 13% are now 13.8s. Our new deals are 13.5 starting, and hopefully going up from there. But as I just mentioned, our portfolio, across the portfolio, is 13%. So,
and Neil, can I just chime in just briefly, just to put some numbers into that? Neil's talked about the adjustment factors and how we're inflation hedged. During the interim 6-month period, we've had 5 of our royalty companies. The adjustment factors have come up for review, and all 5 of them have been +6 adjustments. So you can see how that sort of inflation hedge is actually kicking in now.
This is our royalty partner portfolio right now. I want to go to another slide, but what we'll talk about here is just, you know, the use of our capital, for acquisition capital, debt refinancing. There's management buyouts that we like as well. So, you know, for companies and business owners who want to keep control, having a minimally dilutive solution that keeps them the equity control while they're acquiring new businesses, for example, or in MEO situation, the management team that has created these profitable businesses for years now have the opportunity to become owners. There's a real incentive for them to have the majority control of the company, and us having a minority stake. Fabricat is one that you may recall, a very industrial business doing lampposts and guardrails for councils across the UK. The three people who own the business now, 2 of them have been with the business over 30 years, and it's a great story. We're going to talk more about that as we go through 2023, because it's a really great story. I had dinner with them 2 weeks ago in London, and it was just heartwarming to hear their story of now this changing their life, because they're now the owner of this business, and the results have been fantastic for everyone this year. We like industrial business, as I say. We like business services. So we spread out the diversification over companies in industry, of geography, even currency. So we have a broad base of diversification and different transaction types. And one of the things, as I said, you know, that we're looking at is not just the 14 businesses that pay us, but now we have exposure to 56 underlying operating companies. And so we're going to get to New Path, which is a roll up, but we see that in Intech that you may recall. You've seen that in Lynx, which is a 5-year royalty partner. Now we bought 8 different companies in the UK and in Western Europe. So we love these type of businesses. We can continue to invest in the same royalty partner. It diversifies the revenue. It's the same return, but a lower risk because we know the counterparty. So we're really excited about how our portfolio is shaping up. New Path, as I said, you can see the term, the initial obligation is 13.5%. So as I said, really the top end of the range, which now we're not budging on. The annual adjustment is the same. It's a buy and build transaction type. So it really ticks a lot of boxes and diversifies our risk. And quite frankly, this is a B2B business. Everyone, you know, there's other questions about, you know, prolonged recession, which I know is a big concern. We have business to business portfolios. We're not immune, of course, to the consumer not spending money. But for example, like New Path, these are businesses that have fire and security, that they will be paying this maintenance and security systems on a monthly basis, and you're not going to stop paying for your fire and security services. So we like the defensive nature of this company. We like the management team. We invest in people, so management team is very important. Andrew has done a roll up before owned by a private equity. Private equity loves, roll-ups. He did this with some of his own capital for himself. Now he's the majority owner, and he found Duke, actually a podcast that I did called Buy and Build in the UK, and it's like, wait, I get to own the company, and you can continue to invest and buy these companies if we have the same criteria, and I'm continuing control, and this is it's exactly what this is all about. He's been successful before. We can back this owner, and as he grows, we will continue to improve that investment and increase that investment and hopefully improve it. But that's our latest royalty partner, and ticks a lot of the boxes of what Duke Royalty is looking for. And as you guys have heard us before, I'm really excited about this because it's very in line with how we invest. Hugo, you want to take this one?
Just shows our shareholder list. It's something we're very proud of. We've got a lot of very strong blue chip shareholders there. M&G, Columbia Threadneedle, Gresham, shareholders we're very proud to have, and who have been shareholders with us for a very long time. But at the same time, you'll see a number one shareholder there, Hargreaves, and number 3, Interactive. So we place a lot of importance on our retail shareholders, and I believe we have historically have had a very good following, and is the exact reason why we like to do the IMC and other retail webinars as and when we can. But also down there in the bottom right, directors, management, shareholders hold 3%. So it's the Duke management, the Duke board has skin in the game. We want to be aligned with our shareholders. We want our shareholders to benefit from the success of Duke, and having sort of management ownership is important in that alignment.
Yeah, we've invested in every round alongside some of you, and we always write a check, and that's important. It's important for us to have that alignment for our royalty partners, that they have skin in the game, and they lose everything before we lose a dollar in their case. So we know their minds are focused, but it is it's important for that alignment to have money at risk, and so we look for as well.
A couple of post-period end highlights, and then I can sort of pass back to Neil for to summarise. From a finance perspective, you may have seen we released a trading update last week on the back of our interims. Q2, which we've obviously reported on, was a record 5.3 million, and we expect to continue that increase in top line cash revenue to 5.5 million for Q3. In terms of the portfolio, as Neil's just talked about, we've made a new 5.5 million investment into New Path Fire and Security. We're excited about that one, and we hope that that's a fairly historically low or smaller investment for us, or initial investment. But the great thing is it should provide us with plenty of follow-ons over the next 2 years. And again, as I've talked about, increasing average cash yield across the portfolio as those adjustment factors take place. In terms of pipeline, I'll come on to this again because there are a couple of questions that have been submitted talking about interest rates and pipeline. But suffice to say, we've got a very strong pipeline under review at the moment. We have a couple of opportunities and exclusivity, and while we've taken a very prudent approach to deployment, given the macroeconomic headwinds, I'm confident. Hopefully, you'll see some news from us over the next 3 or 4 months in terms of deployments.
I'm just gonna say it's funny how people interpret our trading updates, and when we said this is a question, so it relates to this. It says, well, your latest trading update says we're taking advantage of the current market when we're seeing other lenders pulling back from making new investments, which I thought was a positive, but it could be construed as this reader says is are such opportunistic investments of lower quality, given that the lenders aren't investing in them. So it does beg that question that I didn't think about when I wrote that. But really, what that means is that, especially in Ireland, okay, I was out in Ireland in October, sitting down with people, and there's the Bank of Ireland and AIB, and they do a lot of loans, but they're when the market's good, they're gonna invest at EBITDAs of 3.5%. They're never at what we're doing, but they will pull back to 2 to 2.5 of a business because their outlook. How banks and bank managers, for example, bank managers are the ones who are on the hook for this loan, and what they are incentivized about is getting fees off the loans and in returning the capital, and then refinancing that, getting more fees, and it's a very short-term mentality. So when something like this comes along in a recession and interest rates, they're worried about their existing portfolio. They're worried about how they're going to get their fees and the money back, and that is different than us in one important way. And this goes to the heart of what the trading update was trying to say, which was we invest over the long term. So in a recession, private equity can't borrow all this money from a bank because they're worried about near term. We only have to do 6 deals a year. Those 75 million pounds of deployments last year was 5 new royalty partners and a bunch of follow-ons. And so that's because we're so focused that we can really get exposed to a lot of more businesses, but keep the quality very, very high, and the high bar, as I said, in this fiscal year, we're gonna make sure that we have a high bar, because there are going to be more opportunities. So we're looking at different things. When I say banks and other lenders, we're looking at different things. We're not all things to all people. We're one slice of this massive pie. And when short-term uncertainty hits the market, both the banks and the business owners, the business owners are looking for long-term partners, and we are the only long-term solution out there for these people. And that's why I'm excited about, we did this. And listen, 2022 felt a lot like 2020. And sometimes, and I say this, even worse. In 2020, coming out of COVID, and I think coming out of this, inflationary and high rising interest rate period, we're also going to have, a lot of market opportunity coming to Duke. And again, we don't need to do a lot of different deals. That's why, I'm excited about this opportunity, and not that we're going to now do the deals that the banks aren't going to do. So I hope that answers that question. Just before we move on, I just want to summarize where we are as a company, and in our excitement about the future. We're the only corporate royalty company listed in London. We pioneered this in the UK, but has been around for decades in North America. We're evident in the downside protection. I hope we've conveyed that today in the capital preservation from what we do. We've increased the dividend yield over the last 12 months. Increased the dividend and while reducing the payout ratio. We do believe that there are buyouts coming in the next couple of years, because believe it or not, there are some companies that are benefiting in this current market environment. So buyouts you will see in the next 12 months. But our core business, it's all about the operational leverage, the cash operating costs coming down as a percentage, our revenue going up through deployments, but also the embedded adjustments and once a year inside our portfolio, which is different from any other royalty company that you will see. And we've talked about the pipeline. As we're not spreading corn on the field. This is always going to be something that we would like to build to about 20 different companies, in the near term over the next couple of years. There's different ways to grow non-dilutively to the shareholders, after that. But, we've done the same thing for 5 years. It's worked. We're extremely happy about these last 6 months and the outlook. And so that's what I'll leave you with, and we can get to questions. Look at that, 45 minutes, just as we drew it up, Hugo.
Well done. Well done. Well, why don't I take the first question then, which is, there have been a few questions about sort of rising interest rates, the effect on our portfolio, and specifically, how it affects Duke's business development pipeline. Well, Neil's already touched on this. We've always sort of said our starting yield is between 12 and 14%. That's definitely, we're looking at the higher end of that at the moment, given the environment. But we are long-term investors. Our product is a 30-year investment. So we take a much longer term view than all other lenders. And therefore, we've decided, we don't want to increase our starting position. If you take the view that interest rates will hopefully normalize, in 18 to 24 months, then we're pricing ourselves out if we go too high. And actually what that's meant in terms of the pipeline is that Duke as a product is becoming more and more competitive, because mezzanine lending and bridge loans, etc. All that type of debt has gone up significantly, and people are starting to look longer term. And we just look at our pipeline at the moment, and especially in North America, that's sort of as strong as it's ever been, partially on account of the fact that we are now a more competitive product.
I think there are a number of questions that go to the heart of shareholders, which is the stock price, and comment on what we see and that I think. Listen, I spent my life as or a previous chunk of my career as an investment banker in an investment bank. So stock prices are always the barometer. But as a CEO, what I'm focused on is long-term cash flow and long-term growth of our NAV and our cash flow per share. So the day-to-day stock price is not what we're looking at or what we're concerned about. However, it does merit the comment that our stock price has always been around 5 to 6% dividend yield. Okay, and as we increase the dividend, staying the same dividend yield, our stock price will increase, and we have done that. But last year at this time, I noticed that our stock price was over 40. It was like 44, 45p, and that has to do with the risk-free rate. So if you can get 3% from your bank, you're not gonna buy the Duke at 5%. So that has increased our dividend yield because the risk-free rate is so much higher than it was 12 months ago, and I think that is going to be like every one of your other investments that is a dividend paying stock. That will affect all the boats in the entire market. I think what we can offer is, and this has been proven again through market downturns, is in a bear market in the stock market, royalties actually are a really good place to put your money because of the cash flow. The Duke royalty is our cash flow per share, because our revenue is a percentage of someone else's revenue, not their EBITDA. Our EBITDA is staying the same, and ultimately ours is increasing. So, but you've seen that in other royalties, in other jurisdictions, and other stock markets, in other recessions. So, we're not immune to what's happening in the broader market. Who we invest in, I think there's obviously some questions around what's happening in a prolonged recessionary investment, and we're still 5 years old. 5 years old as a company, so we don't have a lot of track record to prove what happened in '08. But we so there will be some shareholders that are not buying our stock because of the uncertain short-term outlook. So all we can do as businesses, as a business and a public company, is continue to do what we tell you we're going to do. One of the things that is going to get to how we're investing in our IRRs is to lower our cost of capital in our borrowing, which is something that we've told investors before, and things like that we are working on, and so we have been working on that to both increase the size of our debt as well as the cost of new capital coming into to Duke. So we have been there's nothing to announce right now, but we have been working on that. That's part of the strategy to increase the per share metrics, because that'll be non-dilutive new capital for us to invest at our initial rates that we're talking about. So those are the things that we can do. The stock price is a reflection of the market uncertainty, and all I can say, is I hope Duke is one of your better performers in your portfolio. If you think about the 14p that we've been able to give back to shareholders in the last 5 years, that adds to the return that you have. So it's not just a stock price.
I say probably a couple of questions I can answer quite quickly. You say Duke is the only UK listed royalty business. Do you not count Trident Royalties? The focus here is on a corporate royalty company. Not I believe Trident Royalties is a mining royalty company. There are other few.
It's oil and gas.
Yeah, there you go. So we are the only corporate royalty listed corporate royalty business.
Yeah, and there's the Song royalties. There's Silver Wheaton as a big mining royalty company that's now listed in London. But as I said, those are all the kind of the traditional IP based depreciating assets. So their revenue is going to go down. They have to keep investing and keep supplanting that lost revenue with more revenue to keep growing. And what we've been able to show is there's embedded growth within our portfolio, which is unique.
Andrew Ems asked, how do you calculate the NAV? Well, the NAV is simply the net assets of the business, or the balance sheet, the net assets, and NAV per share, obviously net assets divided by the total share count. And really what drives that is really on the balance sheet perspective. If you think about it, it's really two things. It's the fair value of the investment portfolio, which I've talked about, as well as how much additional free cash flow we generate on top of what we pay out in dividends. So those are the two things that really will drive that NAV up, is increase in the value of the investment portfolio, and as we lower that payout ratio, we will sort of deploy more back into the portfolio. And hopefully, as Neil's talked about, the life cycle of the investments, as we get significant buybacks, that's when hopefully you will start to see significant sort of material increases in NAV as and when those buyback happens, especially in the ones where we have decent equity stakes.
There was a question from Vivian about do you pay for the equity stakes taken? It's a very minimal cost that we attribute to the equity stakes. Sometimes we took equity in lieu of our cash payments, and that was through COVID. So you'll see UGG, United Glass Group, we got 30% through that mechanism and whatnot. But Hugo, you might want to just comment on how do you go about valuing them on the at the point of purchase and attribute on your balance sheet.
Yeah, well, the point of purchase is very often we for instance, we take equity stakes, as I said, where we can. But if you, as an example, if there's an MBO, the MBO team will be paying a price for the equity, and if we join them on that, we'll come in at the same price. So, generally speaking, the type of business we invest, there isn't a huge amount of equity value on day one. They're taking our capital to build that equity value, and hence why it's generally good for us to try and get in early. I've touched upon earlier how we value that. I look at those on a 6-month basis. They're audited once a year by my auditors. I take a forward-looking EBITDA multiple, which is based off management estimates, management forecasts, which Duke has a lot of involvement in. And then I apply a market sector multiple to that, but discount it pretty heavily. And you can always imagine, I discount it, and then my auditors come in with a knife and discount it more. So I think, I genuinely believe that the valuations that we've got at the moment are a fair reflection of the equity portfolio as it stands.
I want to touch on one line of questioning around the kind of level of losses and how do we think about expected loss ratio and things like that. I think that really is a good kind of loan portfolio type question, which the way we invest and which is why we're not a loan. We're not term loans, and that's kind of the very much bank manager mentality of the loan loss ratio. We safeguard ourselves from losses as through our payout ratio and dividends. We're protecting our dividends so we don't have to cut our dividend by lowering our payout ratio. That means that we'll be in the 70s. We've always said we want the run rate revenue, the payout ratio on a normalized basis to be between 60 and 80%. And when we were building the company, in that phase one, we were much higher than that. We were paying out mostly all of our free cash flow. And now we are much more safeguarded against some losses. What we do, and it goes to a couple other questions, in a prolonged recession, is what we did in COVID. Is we can afford to, in a long-term loan and a long-term partnership, if their cash flow is being squeezed. And remember, we're only taking half of the cash flow, less than half the cash flow right now. But for those companies that are on the higher end, we can forego payments. And we talked about, it's not 100%. We've talked about this before. Trimite, which is one of our earliest investments, is only paying us half, and they are restructuring their business, and we are accruing the other half of the payments, but we are getting paid by them, but only half of what we're due. They will have to make that up. In COVID, we also equitized some of our payments that I mentioned before, and so we believe that these companies that again have been around for decades and seen lots of recessions in their time frame, and we invest in people that have been the ones that created this cash flow and understand the dynamics of the business, that we back them over the long term. So if we have to pull back the cash, it will not affect the dividend, and that's what we're gearing towards. We have that buffer. The loss of cash may be short term, bringing it back up, and that's the way we think of losses. But we are preserving that capital. And the 5 buyouts that we've had, 4 have been in the 20% IRR, and 1 was -2 for long-term shareholders. Of course, Riverboats, that was our first ever investment. We got our capital back after a 100% decrease in the entire industry of ferrying 80-year-olds up and down Central Europe in close quarters riverboats in the summer of 2020 was not something that was expected. And but we got out of that investment in a negative 2% IRR. So, we have proven the way we invest is geared towards capital preservation. The cash flow is king, as Hugo had mentioned, and that's the way to value us or measure us as what we do, and we're at record cash flows currently. Hugo, you got time for one more? We're out of time.
I was a bit worried we're out of time. I can see that I can answer one very quickly, which do you have a target level of gearing? We set ourselves, generally speaking, internal limit of 40% LTV. We don't want to overgear the business. We're currently at around 30%, I think. So we've got plenty of room, but you won't see us going above 40% gearing, certainly not in the short term.
Neil, Hugo, perhaps now would be a good time for me to jump back in, and thank you very much indeed for your presentation and for addressing all of those questions that came in from investors this afternoon. And of course, we will give you back all of the questions that were submitted today, and we'll publish all those responses where it's appropriate to do so on the Investor Meet Company platform. Neil, perhaps before redirecting those on the call to provide you their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Yes, closing comments. Thank you for your time. Thank you for being shareholders, of those of you who are. We do these to really connect with all shareholders. I think it's a very important part of what we do is to keep communication, direct communication. Love your feedback, your questions at any time, not only IMC, but any time. And we're just very pleased that what we've been able to tell our investors, we've been able to deliver on. And I think that's what we cannot predict. The market, the interest rates, global pandemic. What we can commit to is doing what we say we're going to do in the face of an ever increasing set of global curveballs that may come from left field. So we appreciate you being shareholders. I hope you're long-term shareholders, because we're building a great company for the long term.
Neil, that's great. And Hugo as well, thank you once again for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Duke Royalty Limited, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you, everyone.